Hello. Hope everything is well. I'm gonna talk about the profitability analysis. How can you know whether your business is doing well or not in generating profits? Let us have a look, very fast look on the profit and loss account and some information from the balance sheet. You have the revenues, the total sales, minus your core cost, like material cost, core cost. For the business, you will get a gross profit after you deduct the cost of revenue from revenue. All the supporting activities from marketing, HR, and so on are in the expenses. Then you'll get your operating profit. Sometimes you call it the EBIT, earnings before interest and tax. You deduct your finance expenses, the interest expense on loans, you will get profit before tax minus the tax, corporate tax equal net profit. This is your total investments in the business, total assets. This is something called capital employed. When you deduct from your total assets, what we call it the spontaneous financing, the finance, the liability without interest or without economic cost, like the accounts payable or the accruals. Then you will get the total equity, which is the shareholders' contributions in the business, the capital they have injected and the profits they have retained and reinvested every year. Okay, based on the information in front of you, the business is doing better in 2023 in terms of generating profits or not. We need to look at the profitability of the business from two sides. The first side is called the margins. The margins. The second side in looking at profitability is called the returns. The margins measures the ability of the business to squeeze profits out of revenue through cost optimization, through cost efficiency and revenue growth, right? Revenue growth has to be higher than the growth in any element of cost to be more efficient, all right? To increase your profit margins, to increase the ability of profits squeezed out of revenue. Let us have a look at that. In 2022, the business was able to generate 33% gross profit margin. Whenever you are talking about margin, it is the item you are talking about divided by your top line, which is revenue. Gross profit divided by revenue. Operating profit margin, operating profit divided by revenue. Net profit margin, net profit divided by revenue. Now let's have a look. Gross profit margin is declining from 33% to 32.1%. So it looks that you have a problem in cost efficiency and cost optimization in the cost of revenue, in the direct cost, like maybe material cost or something like that. So we need to explore that further on. Let us compare what happened in 2023 by the trend, by 2022, and by the benchmark, which is the average of the industry and the competition. Well, you are in the range, but maybe you can push yourself a little bit more by cost optimization and revenue growth, and to go back to increase your 33 point, yani, to the 33.3% as well. Operating profit margin after deducting the overhead expenses, right? Like the marketing expenses, the general and administrative expenses, you will get 11.8. Well, it's getting better now in 2023. It looks that they tried to overcome what happened in the material cost, for example, by squeezing a little bit their administrative overheads. Then 13.51, 59, still you are below the benchmark. You need to put a higher targets in your coming financial plans and budgets to try to bridge the gap between your results and the benchmark. All right. Net profit margin after deducting the interest expense, after deducting the taxes, 5.76, 7.1, a good increase in 2023 on a trend based on the previous periods, but still below the benchmark. You need to bridge this gap by putting tougher targets, higher revenue rates, growth rates in order to achieve the benchmark. This is the first thing, the profit margins. The second thing you need to look at in profitability, another item called the returns. So we have here the margins, measuring the ability to generate profit out of revenue. It measures the operating efficiency. It's all P&L items, all from the profit and loss items, revenue, cost, and profit. And you have the other thing, which is the returns. Now, there is some items from the P&L, income statement, and some items from the balance sheet. All right, let us see. Return on assets, how well you used your assets and investments to generate profit. You have your investments well maintained. You are using your investments, your equipment, your assets with a high utilization rate, 90-95% utilization rate. So you are using it to produce a lot, for example, making more revenue, and you can generate from revenue the highest possible net profit margin, so you can increase your return on assets. It is almost as near to the return on investment, the ROI. So you are getting better in 2023, yes, but still below the benchmark. Another thing called the return on capital employed. When you deduct from the total assets what we call the spontaneous financing, which is the financing without economic cost or interest cost, like the accounts payable and accruals. Net profit divided by capital employed, as you can see here. Well, getting better, yes, in 2023, but still below the benchmark. Return on equity, the profit you are generating above the shareholders' equity. You are taking the shareholders' money and using it quite well in order to be able to increase the profits on the shareholders' money. Now, as you can see, it is from 8.1 to 11.8, but the benchmark for return on equity in general is around 20% or above. The benchmarks changes a little, especially in the profitability from a sector to another and from an economic condition to another. But these are more or less uh, averages, which is still okay. All right. Just a last comment. Why the return on equity is bigger than the return on investment or the return on asset in both cases? Because your assets are not only bought from equity, you used some debts, some liabilities in this case, to increase the value of your assets, to increase the investment base, to increase revenue, and to increase profitability. So what happened here is called the concept of leverage, of financial leverage, using debt finance to increase the ability to generate more profits on the shareholders' money. I hope uh, this was a nice glimpse about how to look at profitability. All these ratios are extremely important because we use these ratios in putting new plans for the future, in putting budgets and future plans and targets to be able to achieve the benchmarks. Thanks a lot. Have a good time. Bye bye.